Hello everyone, welcome to Accounting 312. In this video, we will talk about Chapter 13, Pricing Decision and Cost Management. This is, as I said, it's kind of a lighter chapter, so I'm not really going to talk too much. So I will just go through the PowerPoint briefly and then talk about some calculation. Okay, so the whole chapter 13 talking about one word, basically is pricing. How do you set the proper price for your products, right? If you sell too high, nobody will buy yours. If you sell too low, then you cannot get benefits, right? So we want to set our price properly. Before we talk about the specific method, I want to talk about the concept background. There are three factors that will affect our pricing decision. You have learned that in your economics or classes, right? So we said all the prices actually they are decided by the demand and the supply. So you have demand curve, you have the supply curve. So this will be the supply curve, right? Higher price will have more units supplied, but this will be the demand curve. So because if it's more expensive, the demand will be lower. So there are three factors that will affect demand or supply or both. We said the first one is the customer, and then customer will affect the demand curve, because if you have more customers, you will have a higher demand. If your demand increases, then you will have a higher price there, right? It increased from your original price to go to the higher price. So customer will affect the demand curve. And then we said that the other cost, better is costs that will affect the supply curve, right? So if the cost goes up, the supply will going down. So that is the cost will affect the supply curve. And then we said in the middle is the competitor, competitor, it will affect both, kind of in the middle. So that's our three C's that will affect our price. And then we said the different factors, they will be different based on the market situation. So if the market is no competition, or it's, well, let's say it's very competitive, let's say it's really competitive. So basically, you sell this pen, your competitor also sell this pen. If your competitor said, hey, I sell at $1, you cannot sell at $2, right? If you sell at $2, nobody will buy yours, they will go to your competitors. So the selling price is actually set by your competitor, by the market. The main thing you can focus on is the cost. So what you can do is you try to control your cost so that you can also sell at $1 or even 90 cents by decreasing your cost. So if there is no competition and you are the only person in the market, what is more important is the customer, their requirement, right? So if you have a unique thing, let's say all the other competitors, they only have this black pen, but I have this green pen. So nobody can compete with me. I can sell it at $10, $20, as long as the customers, they are happy with my product. Then you will care about more of the customer requirements. And then we talk about in the long-term pricing decision, this is difference. Chapter 11, we talk about the short-term. We said the main thing is we only look about the relevant cost, right? We said, hey, as long as it's relevant, we cover relevant cost, that's all. Chapter 13, we said we think about long-term asset. We think about long-term decision making. We said you have to cover all the costs, and then you also need to charge a little bit of profit so that you can stay in the business for the long term. So the main thing, I'm not going to do the calculation, but this one said, hey, in chapter 13, if you talk about long term, you have to have all the costs and then also add a certain profit. In the short term, you only look at the relevant cost, which is the avoidable costs in our chapter 11. Did I talk about chapter 11? So if it's chapter 11 short term, then you only look at relevant cost. If it's chapter 13 long term, you think about full cost plus the profit. And then since we think about all the costs, then we have to allocate the indirect cost to our product. So there are 4 purposes of cost allocation. Just to read the textbook a little bit to get some idea. Then we talk about the specific 2 approaches for the long-term pricing decision. We said the first one is market-based. Is basically if the market is really competitive, you ask, hey, given the market and the competitor already set the price, what price should we charge, right? We should try to match them. And then based on the cost, if there is no competition, then the selling price is what's our cost that we produce the product, we have to cover the cost, and then we also get a certain return as our profit. We talk about the first one, market-based approach. Basically, you have 4 steps. I'm not going to really read, but the logic of a market-based approach is that the market already set the selling price for you. Let's say everybody sells at $10, so you can only sell around $10. And then you want to get your profit, let's say maybe $2 each. Then you have to derive your target cost has to be $8, right? You cannot be higher than $8. If it's $9, then you cannot get $2. You can only get $1. So you have to try to decrease your current cost to your target cost by doing value engineering, Let's look at an example. Said that so you want to get 10% as your profit. Totally, your current revenue is 160 million. So your operating income, total operating income will be 160 million times 10% gives you 16 million. But that is 200 units, right? So for each one, will 16 million divided by 200,000 units will be $80 for each one. So for each one, you will earn $80 as your target operating income. So your cost then will be your selling price already said, market said, hey, you can only sell at $800. And then you want the operating income to be $80 each. Then you derive your target cost as 800 minus 80 gives you 720. Your current is 900. So your goal is to decrease your cost from 900 to 720 by doing value engineering. So what's the meaning of value engineering? I'm not going to read about value engineering. Is a systematic evaluation of all aspects. Everybody has to be involved, from your R&D, from your manufacturing, from your distribution, from your customer service, right? Everybody has to be involved so that you can decrease the cost, but you also have a good quality. We cannot say, hey, we decrease the cost and then we just have a bad quality. That's not value engineering. Value engineering is cut your cost but still maintain your quality. Some terminology, we said we have to separate value-added costs and then non-value-added costs. So from the name, we said value-added costs, those are the costs that will add value to a product. Like, as I say, hey, if you want to have a phone, let's say just you want to have a phone, right? And then you said the phone cost is 800, so I want to decrease it to 700. What I will do is I use better material, I use better camera or something. Yeah, that can decrease the cost, but that will also hurt the usefulness of your phone. You use a low quality camera, customers will be unhappy, right? So that's value added. The material, the labor, good quality, those are value added, because if you decrease it, you will hurt the usefulness of your product. So we should not cut this cost, because if you cut this cost, the usefulness, the utility, the value will be decreased. What we should do is we cut the non-value added cost, because those are the costs that will not add value because they are non-value added. If you cut it, it will not affect your usefulness of your product. You will say, hey, what are these costs, right? We said, because of your mistake, you have to redo the product. If you do it once, you only cost $5, but because you did it twice, then it costs $8. So the extra $3 will be non-value added. You should have finished it in one time, but you did 2 times. So you wasted the $3. When you charge your customer said, I'm only going to pay you $5. You did your mistake. You spent extra $3. That's not my bad. That's not my fault. I only pay you $8. I only pay you $5. I don't want to pay you $8. Then the extra $3 will be your non-value added cost. And we should try to decrease these costs. Okay, the next thing talking about value engineering. The other terminology is cost incurrence and locked-in costs. So cost incurrence is from the name, is when you really use the material, when you really use your labor, when the cost is really incurred, right? When the cost is really incurred. So what's the meaning is when you have your manufacturing, so this is your value chain. You have R&D, you have manufacturing, you have marketing, distribution, and customer service. So those are the value chain, right? We will have a lot of cost incurrence in the manufacturing time, in the manufacturing department, because that's the time, that's the department really uses the material, really uses the resources, right? The resources are really incurred, are really used to produce your products. There is another cost called locked-in costs. So they are not really incurred, but they will incur in the future because of something decision you are making. What's the meaning? Like, let's say, I always use this one, said, hey, I think I want to make a pen, right? And then in order to make it so fancy, I will put some, gold maybe here in the outside of this pen, so it will be a gold pen. So you made that decision when you design your pen. You said, I want to decorate with a pen with a diamond, or with a diamond maybe. I make diamond pen. So you made the decision. That's your R&D. You said, hey, I will put a diamond. But you made the decision, right? Then at that moment, you haven't purchased diamond, but you just made the design, you will put diamond. Let's say you made the decision, you made the design in January, and then in August, when you really try to manufacture the diamond pen, the diamond cost went up. Can you really go back to January and redesign? You cannot go back, right? You already locked the diamond cost with the pen when you did the design. At that moment in January, you haven't purchased diamond. You didn't really pay for the diamond cost, but the diamond cost is already locked in with your product. So later, no matter the diamond goes up or down, it's hard to change those costs because the diamond cost is already locked in with your product because of your unique design. So we said the locked-in costs, they have a lot during the R&D department. At that moment, you just design, you just put it in the picture, you didn't really buy the diamond, but you already locked the diamond cost within your product. So that's the locked-in cost. So we said the best opportunity is that if you want to avoid some costs, it's before it's locked in. So you said, hey, I don't want to take the risk of having the diamond huge costs. Then when you design your pen, don't put that diamond in your pen. Then it's better to predict, anticipate this cost when you research and design your product. Okay, so that's the basic part of your first method, market-based approach. Second one called cost plus pricing. And then this is really nothing really fancy. Basically, you have the cost. We said the cost of this pen, I just make up a number, is $100. And then you want to charge profit, right? You want to earn money. I said, hey, I charge $20. So that is your cost. That is the profit. We also call it a plus. Your cost plus the plus is your selling price is $120. That's it. So the key thing here is how do we get a plus? So the plus we also call markup, and then we also call the profit, right? How did we get this $20? We got this $20 based on our investment return, So I make up a number. I said, hey, you total invested $10 million, and you require your return has to be 10%. Therefore, your total profit, right? Every year you have to earn $1 million. Because you invested 10 million, you won't get 10% as return. So every year you have to get $1 million. So let's say you have 500,000 units, okay? Therefore, for each unit, you have to require $20 as the profit. So therefore, this $20 is your markup, is your profit for that product, is the plus. So we get this plus, we get this markup, we get this profit based on our investment return. The 10% is our investment return. We also have another percentage called the markup percentage. Basically, is your markup divided by your cost is 20 divided by 100 gives you 20%. So you have a 20%. This 20% is your markup percentage. The 10% is your return percentage. So don't mix these two percentages. You use your investment return to get your markup. You get your markup to get your markup percentage. Okay, so let's look at this example. This is from your textbook. So we said in this chapter, we use our total assets, long-term assets plus current assets as our investment. So you have your total investment of 96 million. We said that the return has to be 18%. So our total investment return, the income profit has to be 17.28 million. We total have 200,000, so each one gives us 86.4. That is your markup. So that is your markup. This is also your profit. This is also your plus. So our cost is 720,000. Remember, our markup is 86.4. So we got our selling price will be 806.4. And we have our markup percentage, right? We said the markup percentage. So markup percentage is your markup divided by your cost gives you 86.4 divided by 720. This gives you 12%. So that 12% is your markup percentage. Your 18% is your investment return percentage. So make sure you don't mix these two percentage. And last thing we said, hey, for the cost plus pricing, you can have a different cost base. You can use your full cost, you can use manufacturing cost, you can use variable cost, you can use variable manufacturing costs. So we said that the full cost basically will be the higher, right? Will be because it's full cost. Variable manufacturing most likely is the smallest one. We said that we want the selling price to be around 800. So if you have a big base, then your markup just need to be small. So if your base is 720, your markup just need to be 86.4. But if your base is small, if your base is only 475, then your markup has to be big to reach the similar total of $800. You know what I'm trying to say, right? So if your points, you got 50 points, right? You just need to, a total, let's say you got 50 out of 60. And then you just need to get bonus. I just say you just need to get bonus of 5 points, 10%, right? But if you only get 10 points out of 60, then you want me to give you a bigger curve. You want to get like a 40 points curve, right, which is 400% or whatever. So if your base is big, you just need to have a small markup to get the proper selling price. But if your base is small, then you have to mark up a large amount to get the similar selling price. And then we said in the reality, basically managers, they prefer to use the full cost because of these 3 reasons. I'm not going to really read, but those are the main thing in the PowerPoint. So I will post my solution to some practice in the Blackboard. I may make a video, I may not make one, but I will let you know. So this is all about chapter 13, talking about how do we define our price. Okay, please let me know if you have any question. Thank you.